Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to discuss the subject of how real estate investors manage to pay little to no tax in a bunch of different situations. So I'm going to explain to you the mechanics and realize that these typically work in countries where borrowing and leverage is easy and that you're a resident who can take advantage of that. So in a lot of cases, you're not going to be in that situation, but maybe if you're living in the US, you're living in Canada, you're living in Australia, you're living in UK, you're living in a variety of other countries, this might be an option for you to be able to, hey, optimize your taxes and show how, hey, real estate could be an income option for you for future and why. Maybe it's attractive from a retirement standpoint. So before we get into that, if you haven't already, smash the subscribe button, smash the notification bell, make sure you don't miss out on any of our future videos. And if you're interested at all in international tax planning, how to reduce your tax to as low as legally possible, close to zero. If you're interested in opening offshore bank accounts, opening offshore companies, setting up second residencies, citizenships, getting your second passports, etc., reach out to me, book a call, clarity.fm/Michael Rosmer, there's a link below, or visit our websites, offshorecitizen.net, offshorecapitalist.com. All right, now, so here's the real estate strategy. So real estate in a lot of places is pretty tax advantaged already, and I've kind of done some previous videos where I've talked about this. Because of the fact that you can often get depreciation, you can get write-offs, the capital appreciation portion is deferred, etc. This can be pretty good. Now, generally speaking, there's two downsides. One is, hey, listen, rental income is fully taxable after any deductions that you can get, and that rental income, unfortunately, is very clearly associated with where it is. Okay, so that's a disadvantage. There's just like, what if you have a property in New York, that property's in New York, that's clearly New York source income. There's no way you can argue, hey, well, that's actually, BVI income. No, that's New York income. At the same time, also, in most cases, whereas if you have a share, like say for instance, I'm not a US resident, I buy a share on the US stock exchange, I sell the share, I don't pay tax in the US on the gain in the share, okay? There'd be withholding tax on dividends paid, but I would not pay tax on the gains on the shares. If I buy a property in, the US or UK or Spain or wherever, I'm gonna have taxes on that, okay? In addition to, whether there's stamp duties and transfer taxes and property taxes and all this other kind of stuff, I'm gonna pay the capital gain there in most cases, okay? So, what then is the attraction, right? If I can't, plan around this, why would I do this? Well, here's the thing. Let's imagine a scenario under which you go and you say, hey, listen, I'm going to buy a property. It's a cash flowing property that I'm going to rent out, okay? Maybe I'm going to buy 10 of them, 20 of them, 100 of them, however many, right? I have a friend who just bought 10 properties this year. So great, you've got a little portfolio of 10 more properties. That's excellent. They're paying you cash flow every month. You can maybe depreciate the property so you can get some write-offs for that. You can be in a situation where, just the general business, et cetera, of real estate, you're able to write it off. And sometimes you can have what's called negative geared properties, which is where the property may actually be positive, but due to all the write-offs and the depreciation, et cetera, you're actually showing losses on them. So that's pretty cool, right? Not necessarily amazing for, the world, but hey, for an investment standpoint and tax optimization standpoint, it's pretty good. In that situation, you're usually going to have a mortgage, okay? So you would typically go in and your ideal is you buy a property for less than it's worth. So let's just say, for instance, you buy it for 10% below, which you should always be able to buy a property for 10% below. Like any market, there's just like a natural spectrum. And if you're willing to hunt around, you'll find deals. 10% is a reasonable number. Some people claim they get 30% below. It's questionable whether the real market rate was 30% below as opposed to a previous rate or as opposed to the asking price. That's quite different. But let's assume that you can get 10% below, which you can do with some margin of uncertainty or safety. All right, so you're in that position. The day that you buy, you have more equity than you put in. Now you also probably bought it with a mortgage, okay? So let's just say you put 20% down. 20% down will be a pretty normal number in a lot of different markets. Sometimes maybe a little bit more if you're, actually going to live in there, and sometimes you can get less, but let's just say it's 20% down, okay? So you're levered up 5 to 1. So just for some simple numbers, let's say that you bought a property for $250,000 that was actually worth $275,000. and you put in 50 grand. Now there's going to be some extra costs there because you have closing fees and legal fees and things like this. But loosely we're there, and then you also have a mortgage for the remaining 200,000, right? So you've got a mortgage payment. Mortgage payment is, I don't know, that's if you have it on a 25-year amortization or something like that, you're probably somewhere around like $800 would be my guess, depending on the interest rates and where you are and things like that. But say that's what it is, and you manage to rent it out, and so you're renting it out, and say you're bringing in positive cash flow of a couple $100 a month, right? That would be a reasonable number to get once that you pay the mortgage and you pay the taxes, insurance, maybe there's condo fees or something like that, et cetera, et cetera. You end up positive a little bit, right? All right, so your cash on cash return is okay. It's like in this particular example, probably about 5%, right? So not great if that's basically just how I'm calculating that is I'm basically saying approximately $200 a month across 12 months is $2,400 a year, which is 5% of the $50,000 that you put in. Okay, that's just for following the numbers along here. So, all right, the next thing is you have some principal pay down, right? And in a situation like this, early on in the life cycle of the mortgage, you're probably paying off, I don't know, maybe about $4,000 a year. Over time, it's going to increase. Maybe it would be a little bit lower than that, depending again on what the amortization period is and things like this. But a little bit is being paid off of the principal, and hopefully you're getting a little bit of equity appreciation each year. Okay. Over the course of time, you're just going to leave that, and it's just going to continue doing its thing, right? Obviously, you have to maintain it, or you have to have a property manager to maintain it, and there's some stuff associated with that. But what I want to get to is the thing about how these real estate investors can end up paying very little tax or no tax. So what happens is, over time, the portfolio goes up, or even if it's not going up, you're building up equity through principal pay down, okay? So let's fast forward 10 years, okay? At 10 years, you've probably got principal pay down of about $50,000 in this example, right? Maybe it's a little bit, probably if you have a $200,000 mortgage, it's probably a little bit less than that, but no, actually that's probably about right. So 10 years, about $50,000 of principal pay down. It's increasing, by the way, as you go on, because as you paid it off, less and less share of each payment is going to interest and more is going to principal, so you're accelerating. So you've got 50,000, plus you already had 50,000, plus you've got 25,000 in equity, plus over that point in time, it would be reasonable to suggest that the property would have gone up by, let's say, 100,000. Okay, 100,000 is probably a conservative number depending on where you buy and what the market conditions are and all this kind of thing. So at this point in time, you have equity in that property of about, $250,000. Okay, so now what do? Well, now you go and you refinance it. By the way, you're probably in that point in time, over this period, your rental rates probably were going up a little bit, so your positive cash flow is probably increasing a little bit, depending again on what also happened with property taxes and whether you had to have some unexpected maintenance expenses and things like that, right? So you say, okay, great, now I've got a few $100,000 in equity. Okay, let's say it's $250,000. Well, what can you do? Now you can go and you can refinance and you can take out 80% of the equity, right? So you pull out. In this example, it wouldn't actually quite work out. They wouldn't give you quite this much because it would be the total amount. But let's just say, for easy numbers, you'd pull out 200,000. Okay, so now you've got 200,000 in cash, right? And the property is you still own the property. The property is still, okay, paying for itself with the renters, etc. How much tax do you pay on that 200,000 in cash that you just pulled out? Zero. You pay nothing on that cash. How much? What can you do with that cash? Anything. You can buy a Lambo with that cash. You can pay for a vacation with that cash. You can go and do whatever you want. Now, a prudent investor may say, hey, listen, that's borrowed money. I'm going to reinvest in other assets. I'm going to whatever. That's totally fair. The point is, you don't pay anything on borrowed money. Okay? And this is, by the way, also how, somebody like Elon Musk probably pays no tax, has probably paid no tax in 20 years, right? Since he sold PayPal, he's probably, or maybe he's got like a small little income, but very little, because where his value comes from is that he is borrowing money against his shares. So, okay, he's got $1 billion that he's pulled out, borrowed against Tesla, SpaceX, whatever, shares. And he's sitting there, he's still holding his shares, he's still, doing well, etc. and he's using that to pay for his private jet, to buy houses, to finance his other startups, et cetera, et cetera. So anyway, that is the story. That is the secret of real estate investing, and how real estate investors, even in a high tax country, can potentially pay very low tax because they can just keep pushing it down the road. Now, in the end, eventually, will this be subject to tax? Yes, it will, right? At the end, of course, when you sell that property, your cost basis was what you paid for it, and you're going to have to pay tax on the differential, right? But you could push that down 50 years. You could be in a situation where, basically your estate ends up paying it after you die or something. So you can enjoy the fruits of that portfolio without being taxed on it, which is a pretty good thing. I hope that helps. I hope that's an interesting little tidbit for somebody who doesn't know about it. It's, I think, a useful thing to understand how there are tax strategies in many different lines of business, and whether it's from film, whether it's, like I said, real estate, whether it's 10 other things, it's a pretty good way to go. So I hope that helps. If you're at all interested in these topics, international tax planning, asset protection, company formations, bank accounts, second residencies, citizenships, moving abroad, investing abroad, reach out to me, book a call, clarity.fm/Michael Rosmer. There's a link below. If you haven't already smashed the subscribe button, click the notification bell, check out our websites, offshorecitizen.net, offshorecapitalist.com. Ask me any questions in the comments below. Tell me what you think. We'd love to hear from you, and I'm going to see you guys on the next video.